computer. So it gives me very great pleasure to introduce my friend and colleague, Joe Hart. I've known Joe for quite a number of years now. We, besides being friends for quite a number of years now, we're also professionals in the, I call it the real estate investment banking, generally investment banking world and so forth. And as I mentioned, I think to several of you before, Joe and I meet up in various parts of the country here, as we were just talking in South Carolina and a year ago, and we were just in Houston recently. Actually, it was the Houston meeting where I was talking with Joe, and he gave an excellent presentation on subjects that we've been talking about in the class here. And so I asked him, I said, I'll come on the fly. I said, Joe, would you come and talk to my class, my investment class at the university here? And he graciously agreed to do that. So he's going to talk about, several subjects related to the investment world, the investing that we've been talking about in the class here, as well as behavioral finance. He has an amazing background in both those. And then he's got a little surprise for us, a little personal story he's going to tell you about, which I think you'll enjoy and you'll be quite surprised about. So Joe, I'll let you kind of tell about your company a little bit. Joe's company is Real Source Properties, multifamily, property developer and so forth. So Joe, I'm going to turn it over to you.
All right. Thanks, Paul, and welcome everybody. Just to clarify the record, I'm about to give all of Paul's presentations. He said he was tired of talking and needed somebody to fill in for him. So I'm stealing his presentations, and just for the record, yes, I am East Coast, so it is a little bit past my bedtime as an old guy. I begged Paul to fly me out so I could be there with all of you. And he said, no, he doesn't want anybody infringing on his territory. So
not quite in the show's budget either.
Here I sit after hours in my living room, speaking to you all. So as a quick background to who I am and why you might give a hoot whether I talk to you or not. I've been in this industry 37 years. I have always, it was almost a misstatement. Since I'm recording it, I can't fib. I've spent most of my career on the product manufacturing and distribution side. So I have worked with organizations that you may be familiar with, but more importantly, some of what I consider to be the brightest minds in the investment management universe, both past and present. I used to have coffee on a monthly basis with the legendary Peter Lynch while I was at Fidelity. Out in your part of the world, I spent a boatload of time with Charles Brandis of Brandis Investment Partners, a global investment guy. And I could brag a lot about other people that I've spent a lot of time with. But so I'll tell you this for a couple of different reasons. Number one, I'm not the smartest guy on the block. But I've been around a lot of really, really smart guys, and I have a tendency to be a sponge, both at the bar and talking to intelligent people like Paul. I don't think I need to go much more into that. I've represented every possible product configuration there can be. I've done fixed annuities, variable annuities, mutual funds, separate accounts, offshore funds, hedge funds, real estate funds, both private and public. Structured notes. I mean, you matter of fact, was part of a group that launched the first publicly traded mortgage fund. And that goes back about a dozen and a half years. So anyways, I've got a lot of background. The fun part is I wasn't always smart or intelligent in our business. I went to college. I got a 4-year degree, but it took me 5 years to get it. I was a college athlete, pursued it beyond that point, but just again to tell you, my 4-year degree, which took me 5 years to obtain in finance, second semester of my 5th year, I learned that I needed an additional 33 core credit hours to graduate that semester, which at the school I went to was a little better than a double the normal load. So being the cheap guy that I am, I enrolled in every class, figured I'd get a running start, and anything that I didn't feel I was comfortable I was going to pass, I'd drop midway through the semester. And that way, when I had to pay for it, when I was no longer on scholarship, I'd have a running start. As fate would have it, I went to school from 8:30 in the morning till 9:45 at night with a break for lunch and a break for dinner. As a result of that, I had my highest semester GPA in 5 years, passed all 33 core credit hours, and graduated with a degree. So there you have it. I'm not smart, but I can learn. Uh, I brought that mentality into our industry for the first 5 or 6 years. And I'll tell you some anecdotal stories, hopefully through tonight, that will help you understand. I've become a student of this business. I've been a student of this business since the mid 90s, so much so that I actually went back to Wharton and got my certified investment management analyst designation. So I approach this business a little differently than the typical sales guy, and that, let's make no bones about it, that's basically what I am. Um, I approach it more like an analyst when we talk about stories. So tonight, with Paul's permission and invitation, and I'm grateful to be here, and I hope I don't bore you all, I am going to ask Paul, I'm sending a request to share the screen.
Got it?
Okay. So there we go. I don't know. Can you see my screen?
Not yet.
Let's see if I can do it again. All right, there it is. So what one do I want here? Okay. Share.
There we go. No, I think it's fine now.
No.
There we go. Yeah, now we can.
There we go. How's that? Is that good?
Yeah, perfect.
So while I talk here, this is a little bit of a setup for my behavioral finance presentation. And again, I just kind of want to walk you through this. I've lectured on behavioral finance for the last almost 20 years. I got hooked on it in the late 90s through a publication I was reading, and it explained essentially everything that I couldn't validate in my own mind based on my direct experience in the markets and with investors in the markets. And what I've learned is when you talk about behavioral finance, the truth of the matter is it's really about behavior. We put finance on it because that's what we're passionate about and that's the business we're in. But it's really about behavior. And when you start to talk about behavior, what you're really focusing on is decision making. And if you boil that one down, in order to truly understand decision making, you need to spend a little bit of time understanding how the human brain works. And I stumbled across this one day, and I actually thought it was hilarious because, believe it or not, I'm betting almost every one of you can read this as if it were printed out properly. So I kind of wanted to set the stage for our conversation. What we want to talk about tonight is essentially modern portfolio theory or portfolio management or financial planning or whatever terminology you want to put to it. I'm going to touch a little bit. I'm not going to go very deep into either modern portfolio theory nor behavioral finance, but it's really all about clients and their money and how they view it. And again, I'm very honored to be asked to speak and present Paul's materials. I hope you all find it interesting. And as Paul introduced, I work for Real Source Properties, which is a multifamily real estate developer, owner, operator, whatever you want to call it. We're vertically integrated. We do everything from soup to nuts. We have an investment platform today called a REIT, Real Estate Investment Trust. Currently consists of 6 properties across 12 states. We launched 45 months ago. We've amassed a better than 153% return in those 44 months. So we're very happy with what's going on and how we're doing our things, and that's our backdrop. I thought what we'd do tonight, don't know if you're going to like the flow. I struggled with it through the course of the last few days as I talked to Paul and put this together. But tonight's discussion, I thought we'd talk about the new 60/40 norm. Where are we and how did we get here is kind of, I'm going to walk you through a history if I can. I think then we'll kind of transition a little bit into money in the mind. And as I said, it's really just about being human. It's not whether you're smart or not. It's how the human brain works. And most of the human brains work in basically the same way. I'll share with you through that process maybe some real world stuff so that you can really understand the brain functionality and behavioral decisions. Um, I'm really not going to spend a lot. I have a lot of slides on this one, but I don't necessarily know if it's pertinent or important for us to go through that, but I do have it, and we'll maybe touch on some of it. I might give you a little bit of the background of my organization and what makes us good. But as I said, I've been in this industry 37 years. I've been public speaking, which I cannot stand, but I do it for all 37 of those years. And I learned very early in my career, you don't really care about what I say unless you know that I care what I'm saying. And more importantly, it's I'm here to educate you, but I also know I can't keep your attention unless I provide some level of comedy for you. So tonight's session is going to be all about educomedy. Feel free to laugh, pick on me, point out things you don't like. I'm pretty solid. I can handle all that stuff, but most important, enjoy the information that we're going to share with you tonight. These next couple slides are of critical importance. And I say that for a couple of different reasons, not the least of which is you know they're critical because A, my lawyer says they're critical. B, my compliance officer makes me put them in every presentation. And C, it's the smallest font you will see in tonight's presentation. And the one thing I know about investing, the smaller the font, the more important the issue is. You better read it because that's where all the meat and the details are. What these actually say to you is in the event you disagree with anything I say tonight or may have said up to this point in my life, or potentially may say from this point before going forward. These three slides tell you that my lawyer will tell your lawyer with a straight face that I was actually never here tonight. So let's kick off and talk about the new 60/40. Historically, the smart way about going through portfolio construction is start at roughly a 60/40, 60% allocation into the broad equities market and a 40% allocation into the income bond market. That's evolved. It's been under attack since it came to light. But when you talk about it, it's very important as well to keep in mind as you're working in a portfolio, your market perspectives. So, that's everything you can possibly think about that you guys have been being educated on, both in Paul's classes as well as your 4 years in college. But there's a lot of things to consider. So it's what I do love about our industry, my business, is every day is a brand new day. They sometimes blur, they sometimes repeat themselves, but the realities of the world are when I wake up every morning, it is a brand new day with a brand new set of challenges to address. So we'll talk a little bit about how that fits into the history and advice of portfolio construction. I'm going to talk a little bit about the need for alternatives, because remember, what I just told you is historically, model portfolio construction has been focused on stocks and bonds, 60/40. And that gets adjusted, that weighting based on the time horizon, risk tolerances, a few other things that you could figure in there. But there's a need for things that are different. And there's a different terminology from diversification and asset allocation, because you could be asset allocated and not necessarily be terribly diversified. So we want to make sure as we look at those things, we understand it, we address it. I'm also going to share a slide with you that says the traditional way of building a portfolio has diminishing options. It's getting harder and harder to find things that can make you different and unique. And then longevity. How long can all this work? And at the end of the day, what I'm really advocating is we start thinking more like institutions and less like investors. And the reason I say that is, yes, Paul.
Yeah, if I could just interrupt for a second. We
Please.
talked a little bit about alternative investments. Actually, we talked quite a bit about alternatives in this class, but maybe it would help if you just kind of, from your perspective, told them what an alternative investment is.
Okay, so the simple definition from my perspective is an alternative investment is anything other than traditional stocks and bonds, period. I actually don't like the word alternative because that starts to make it sound dicey. I prefer to use the word non-traditional. So the things that you wouldn't normally think of as core components in an investment portfolio, be it gold, be it precious metals, be it direct ownership of real estate, commercial real estate, land development. I could run down artwork. All those things are technically considered alternatives. I would suggest to you that most, if not all of them, do have a place in a portfolio, with the caveat being what your objectives, goals, risk tolerance, and time horizon would be. But think of it as anything other than traditional traded stocks and bonds. That would be an alternative. I lean very heavily towards a couple as core components within that alternatives allocation, but we'll probably touch more on that as we go through. How does that sound, Paul?
Yeah, great. Thank you.
Okay. When I say think like an institution, and well, let me just go on and I'll break off and talk a little bit about that institution thing in a minute. So the evolution of this business, the financial advice, and that's what most investment professionals partake in, is professional investment advice with clients. If you look back to the early 1920s and prior to that, most investment, if not all investment recommendations, were based solely on speculation. There really wasn't any formulas or rational definitions behind the recommendations that investors or investment professionals made. There just wasn't anything. It was all speculation. That's why there were so many bubbles and bursts, if you will. Now, what happened is mathematics were introduced into our industry in 1932. That was the first publication of a book called Security Analysis by Graham and Dodd. I will tell you that today, over 90 years later, it is the Bible of the investment business. A matter of fact, you cannot get your certified financial analyst designation without having exposure to Security Analysis, the book. And what that did is that changed us from speculation into the actual evaluation of the underlying value of a security. So they put together a mathematical formula that essentially says can be applied to any security to determine whether that security is overvalued or undervalued. And based on that determination, you can then decide if you should sell it or buy it. And there's a few other changes that have gone on. Some minor changes. The next big one happened in the early 50s. Bill Sharp, guy who introduced capital asset pricing model. A lot of people don't know that Bill Sharp actually took a lot of Harry Markowitz's early works and expanded on them and created the capital asset pricing model. But if Security Analysis put together a mathematical formula to value an underlying security, the capital asset pricing model basically stepped in and said, well, wait a minute, not all securities are the same relative to risk return. So what CAPN says to us is, I should get a little better return if I'm willing to take a little more risk along the process. That eventually evolved into the efficient markets theorem with Fama and French, which then became the modern portfolio theory introduced by Harry Markowitz. Nobel Prize was awarded for that work. And that's something that we've kind of hung on to for the last 60 or 70 years as our rule of thumb, modern portfolio theory. Modern portfolio theory, which is the 60-40 construction model, has been under attack since the day Harry published the first paper. There's always been tinkering. There's always been challenges to some of the underlying assumptions. But at the end of the day, it has been the model portfolio in our industry. We evolved a little further, and this was actually a great learning experience for me. In the late 80s, early 90s, there was a study put out called the Brinson Hood Biebauer study, BHB. You may have heard it in your classes, and I don't know if you can yell out or not, if that's appropriate within your class, but if I were to ask you the question, based on portfolio analysis, what is the believed percentage of return directly attributable to the asset allocation decision as opposed to the security selection decision?
Let's go ahead and have them. Anyone want to take a shot at that? You want to repeat the question again real quick?
What is the perceived percentage of portfolio performance that can be attributed to the asset allocation decision instead of the security selection decision?
You want to take a shot at that?
Well, let me tell them an anecdotal story then, if I can. I got a lot of time. Dinner's not till 7:30, so I can ramble, I guess. So this is kind of fun. I was working at Fidelity in the early 90s, and I was representing Peter Lynch as well as some other very stellar portfolio managers. But in a nutshell, Fidelity at the time was what we referred to as superstar asset management, meaning uh, Ben Johnson would hire two portfolio managers on a fund. They would go out and pick stocks or bonds, what are the securities they wanted to put into those funds, and whoever performed best ended up being the survivor, and he would fire the other guy. They were superstars. And so I was out selling the virtues of superstar security selection. We were the best. I actually used to make the comment, which was true. I don't know if it still is, but even if you don't like Fidelity or you don't like me, don't bet against us because we are superstars. And at the time, we controlled 10% of the daily volume of the New York Stock Exchange. So even if you didn't like us, you bet against us, you were probably going to lose because we could move markets. Now, the funny part about that was one day I was in Washington, D.C., and I was doing a lunch meeting to about 200 advisors at Merrill Lynch, which, by the way, is just as a footnote, it's called the Wild Kingdom, WK, Washington, D.C., and it's called that because it is their single largest rep office in the country. So I'm doing this lunch. I've been there many, many times. And I'm talking about the virtues of superstar asset management, how good we are, and our research is better than anybody else. And I'm just belaboring that point. And finally, one of my producers, one of my clients, well-seasoned investment professional, many years in the business, sat in a corner office, had a very, very large base of assets under his management, raised his hand with a flyer in it, started waving it at me. And I stopped for a minute. I said, "Are you trying to get my attention?" He said, "Yeah." I said, "What do you want to add?" And he responded, he said, "Joe, I just got this brochure from one of your competitors." The company's name was MFS, Massachusetts Financial Services, which was one of the oldest mutual funds in the country at the time. And he said, "I want you to pay attention to the cover." He said, "Joe, the cover says that 96.4% of a portfolio's performance is based on the asset allocation decisions, not the security selection decision." Tell me I wasn't embarrassed in front of 100, 150, 200 guys. I was ashamed. I didn't know what to do. I'd never seen the study. I didn't know how to respond to them. So I just kind of kept talking through it. And afterwards, ran to my phone and called the office. I said, "Anybody know anything about this?" They said, "No, but call this guy over at Brinson." It's okay. Turns out it was a guy I'd known from a previous job that I had. And I talked to him and I said, "I need your help." I said, "A guy just told me 95% or more of the performance is based on asset allocation, not security selection. Is that true based on a study you guys did?" He came back, he says, "Well, it depends on which study you look at." So what do you mean, which study? He said, "We actually did two studies and they're two different numbers. One's 94, 95, one's 93, 91, 92, whatever it was." I said, "Well, wait a minute." I said, "I'm not smart, but I do know math. Great thing about math is there's only one right number. Two and two is always four. Two and two can't be nine, can't be one. It's always four. So how can there be two numbers?" Well, the funny part is A, there were two studies done at two different times with two different data sets. And more importantly, the study did not say that 90% or more of performance is predicated on asset allocation. What it did say is 90% or more of the portfolio volatility or variance can be attributed to the asset allocation decisions, not the security selection. Put that in a more simple way. If I have two portfolios, one does 12% a year for 10 years and one does 10% a year for 10 years. 90+% of the 2% variance can be traced back to asset allocation decisions, but more importantly, actually rooted in the investment policy statement. So what it basically says, what you choose to own or not own in your portfolio will have a material effect on the volatility and ultimate performance of your fund over the long term. So that was a very fascinating learning lesson for me, but also very insightful for us to understand that in 2013, I believe it was, an organization out of Valley Forge, Pennsylvania called Vanguard. Vanguard Group was the bane of my existence and couldn't stand me when I was out in the field working. May still not like me. And John Bogle, who is a brilliant man, great fund manager, and a very savvy businessman, founded Vanguard on the premise that you don't need investment advice because the average investor doesn't beat the market. It's impossible, were his words. The best thing you could do as an investor is to buy low-cost index funds and hold them for the long term. Low cost being the key. Do not hire investment professionals. Do it on your own and just own index funds. Well, 2013, Vanguard commissioned a study to support that claim. What was fascinating is the study came back and actually said the opposite. We'll talk more about that in a minute, but keep that in the back of your mind. But all this up until now was the foundation for what we use today in the 60/40 portfolio. What I'm going to suggest to you is the world continues to evolve and we need to evolve with it. In the late 90s, policy portfolio and the endowment model was introduced by David Swensen. David Swensen was the former CIO of the Yale Endowment Fund. The Yale Endowment Fund is the second largest endowment fund in America. It is also the top performing endowment fund. It beats the pants off of Harvard, and Harvard doesn't like it. But what David did with this policy portfolio was he came in and said, look, we don't want to look like the market. We want to put as many low correlated assets into our portfolio so that we don't have sharp downswings and it doesn't impact our distribution. And this is where I started our conversation tonight, where I want you to think like an institution. Endowment funds are institutions. Now, a lot of people will push on me and say, well, my client or I'm not an endowment. I don't have the same wherewithal or the asset base or the access. A couple of things I will suggest to you. An endowment fund is designed to pay current expenses, grow commensurate with the rising cost of those expenses, and live through infinity. What that basically means is I've got to have a portfolio that's going to kick up enough income that I can pay current expenses for the endowment. I've got to have the portfolio invested in such a way that it has to grow significantly enough to keep pace with the rising cost of inflation, and I can never deplete the asset base. Well, when I step back and start thinking about that, I would argue all of us are basically institutions. Because instead of I can change a couple words in the definition, but think about what you're investing for. You're investing for an undetermined retirement lifetime, which every year gets longer. You need to generate income in every year of your retirement to pay your expenses. And those expenses will rise over time, especially in healthcare. And if we do this right, we should have some left over to bequeath to family, friends, or other things. So if I approach it from that perspective, then it makes a lot of sense for me to start trying to replicate the endowment model for my own personal investment program. The last one is what we refer to now as behavioral finance. That came to the forefront in the late 90s, early 2000s. Today, it is absolutely at the forefront. It's all anybody talks about. It was a Nobel Prize. This was a turning point for me. It was kind of fun in that in 2002, Daniel Kahneman was awarded the Nobel Prize in economics for his paper entitled How Investor Decision Making Affects Market Pricing. Thought that was pretty fascinating when you think about it. For the first time, somebody that is not in the financial services or the financial industry was awarded one of the most coveted prizes in the financial industry, the Nobel Prize in Economics. Daniel Kahneman is a professor of psychology at Princeton University. And he basically said, and this is what really got me going, he explained to me why the average investor doesn't outperform the market. It's not because the market's better, and it's not because we're dumb. It's because we're human beings, and we can't help but make decisions like human beings. This, to me, is the advent of what I'm going to recommend from this point forward, a 50-20-30 portfolio. 50% traditional stocks, 20% traditional bonds, and 30% in the non-traditional investments, or the category referred to as alts. Now, if you want to really talk about this, we can, but think about it this way. In the alts portfolio, you can actually provide current income from non-correlated assets. That's why I took so much out of the bond allocation and not as much out of the equities. But still, this is where I think we're going. There's a lot of academic research being done on this right now. This seems to be, if you will, the sweet spot on the risk-reward trade-off over the long term. So there are three key determinants of long-term investment success. There's the security selection process. In spite of what I said earlier, it is still very, very important that you know what you own. Think of what Warren Buffett is a tremendous security selector, and he adds tremendous value to the performance of his portfolio through that scrutiny of security selection. The second pillar that will determine long-term investment success is the portfolio construction. This is oversimplified for my conversation tonight. It's a much deeper conversation, but just think of this as the asset allocation, the 50-20-30 allocation as portfolio construction. And then the last piece, which is really fascinating, is really the behavioral finance piece, or the behavioral coaching. So I could pick the greatest securities out there, and I could put them in the best allocated portfolio you could possibly come up with. But if we make bad decisions around that great allocation in those wonderful securities, I'm still going to lose. So we have to build portfolios with great investments within them, but we have to behave properly around that portfolio so that these things can do what they need to do, and that is to accrete or build us long-term financial wealth. Now, go back to that Vanguard study. Here's what's fascinating to me. Now, keep in mind, at the backdrop, Vanguard does not like professional financial people. And what I mean by financial people, I mean planners, advisors, whatever the phraseology you want to apply to them is. They don't want investors going and getting advice. They want them to buy Vanguard's index funds and ETFs, low cost, hold them forever, and they will do fine. When the study was ultimately published in 2013, it came out and said, yes, security selection is very, very, very important. As a matter of fact, if you are a good selector of securities, you can add between 0 and 1% a year in overall performance to a portfolio. That's a good number. If you compound that 1% over a 25-year investment horizon, that's real money at the end of it. They further went on to say in the portfolio construction asset placement category, you can generate between 0 and 120 basis points of excess performance. By the way, these are all net of fees and expenses. So if you have a smart person making great investment choices and putting them in the portfolio correctly based on your risk tolerance and time horizon, you can add up to 2.2 percentage points per year, net of all fees and expenses, to a portfolio performance. But check this one out. Behavioral coaching, there's not a range. Even with less than stellar behavioral coaching, you will add 150 basis points a year to the portfolio performance net of all fees and expenses over the long term. Go ahead and compound 1.5% over a 25-year investment horizon or longer. It becomes very meaningful. So now I know I don't have to get securities right, although I'd like to. I don't have to get my allocation perfect, but I'd like to. But so long as I make really, really good choices around those other two pillars, I can be successful over the long term. That's what behavioral finance does for us. So, just a quick slide here so that you know many people don't know this, but a lot of the publicly managed mutual funds and ETFs, they're all starting to become homogenized. In other words, it's becoming really, really hard as an investment professional to differentiate yourself from the pack. And the reason for that is it isn't because we're not good, it's because we have fewer choices. Most people don't know that since 1996, we have less than half of the publicly traded securities in America than we used to have. So we only have half the pool to fish in. So if you're trying to build a portfolio today on your own, as a portfolio manager, be it a professional mutual fund ETF manager, a separate account manager, or you're trying to do it on your own, your choices are dwindling quickly. And we're giving up about 15% of the traded securities on an annualized basis. And that trend doesn't seem to be weakening in any way, shape, or form. So I would expect to see that going forward, which means you really, really, in addition to all the fundamental benefits of owning alternatives in your portfolio, you really need to start considering them. It's the only way to differentiate your long-term fund from anybody else's. Not to mention as well, there's some debate going on right now, but correlations between equities and bonds have become very narrow, meaning they behave the same. Now, some people are arguing today that maybe, I don't know how your political affiliations, I'm not saying this to be political, but there were some pundits that came out recently and said that Donald Trump will make the 60-40 allocation great again because given his views on the economy, finance, interest rates, et cetera, we'll go back to a more normalized spread on correlations. I'm not as sold on that one, to be candid with you, but if you want to buy that theory on the fixed income side, I would lean towards tips because I just don't see, given the fiscal debt of our government and the new administration's at least proposed policies on monetary controls as well as everything else that's out there. I just don't see how we don't have some type of inflation going forward, and that can't be good for the interest rate world. So, real estate as a non-traditional has historically been not only one of the favorite performing on a risk-adjusted basis, but it plays well in almost every cycle that you can look at. So I'm not going to make a case for investing in this today, but as you talk to people, as you do your studies, just understand that there are certain asset classes out there that provide great risk return trade-offs, more so than stocks and bonds historically have. And they do well in some, they do good in most, they do great in others, is kind of what this chart is here to show you. And this is essentially the spread you would see over the long term in indexes during inflationary periods, high inflation, low inflation, et cetera. So again, just validation that specifically real estate, which is what I represent today, it makes a great core allocation in that 30% of a portfolio. Buy it, hold it, don't play with it, let it do its thing over the long term. And this is one of my favorites. You can look at the pie charts and see how they move, but the three lower ones are the 60-40 portfolio. And if I just modify those a little bit, I move dramatically to the return, higher return, and lower risk or lower volatility quadrants of the scale, or just pull out the box in the bottom where it says portfolio allocations. I would suggest to you that you look at the second one down, which is 60 equities, 40 bonds. You have a 9.7% standard deviation volatility measure with about an 8.5% long-term annualized return. If you scooch down to what I'm recommending today, a 50, 20, 30, you have essentially the same volatility, just marginally lower standard deviation, and a full percentage point higher average annual return. So I don't understand why we wouldn't want to put alts into a portfolio today in a meaningful way of at least 30%. And one last one, this is just a commercial message. A recent Gallup poll came out earlier this year, and I love seeing it every year, because in spite of everybody talking about cryptocurrency today and some of the other things that are out there, the realities of the world are savvy investors still like real estate as their primary asset class in a portfolio. And yet the average investor has less than 5% allocated to commercial real estate. I don't understand it, but my job is to try to rectify it. And lastly, this is one that I really like. 90% of the world's millionaires credit their wealth, their millions, with their exposure to commercial real estate. Take Bill Gates as an example. He made his first bit of money in technology, but many people don't know Bill Gates is now one of the largest landowners in America today. Now, I won't go into my thoughts on that, but think about it for a minute. One of the richest men in the world is now one of the largest landowners in America. There's no reason not to own real estate in a portfolio. So let's make this a little lighter, try to get to that edu-comedy piece. I hope you're educated now. That's a joke, guys. You're listening to me, you're not educated. Money, mind, and being human. I'm sure you've heard it. I'm sure Paul has talked about it, but the brain is essentially built into two semi-hemispheres. One is called the fast thinking and one is called the slow thinking. I'm going to give you a couple examples of that so that you understand it. But the triune, sorry about the slide. The triune model of the brain is you need to understand there are actually three core components in the brain. Both fast thinking and slow thinking reside in these three, but there's the hominid brain, the mammalian brain, and the reptilian brain. All are part of the evolution of the human brain, our thinking process, and how we make decisions. I'm not going into neurosurgery right now, but I just wanted to give that to you as a backdrop. You just saw the slide. The fast thinking part of the brain is, I want you to interpret this slide. My guess is, as quick as I pulled that slide up, you knew exactly what this slide was trying to communicate. This person is upset, and they are making sure you know they're upset. Didn't take a whole lot of thought to figure that out. As soon as you saw it, in your mind, you probably went, wow, this person's angry. Let's move you to the slow thinking part of the brain. As quickly as you can, tell me the answer to this. 19 times 24. Wow. If you take a minute and pause, you can actually feel a different part of your brain being activated. This is the slow thinking part of your brain. Now, if any of you are compulsive like I am, I was going to say a bad word, but we're on recorded. You can't go on until you do this, so let me just help you. You don't have to pull out your cell phones and the calculator. It's 456. But I wanted you to sense, if you could, the change in feeling in your brain. And we're going to go through a couple more exercises like that so that you can truly start to understand it. Ambiguity bias. The human brain as a basis is the strongest, most powerful muscle in the human body. I use the word muscle purposefully because it means you can exercise it and you can make it stronger. But even though it's the strongest muscle in the human body, it's the laziest muscle in the human body. It actively seeks ways to not exert energy, to conserve energy. Ambiguity bias is one of them. In other words, the way it tries to save energy is it creates shortcuts in its thinking or rules of thumb. Those technically are referred to as heuristics. And basically, it's a shortcut that says your brain says to itself, oh, I've seen this data before. I know what it's going to do. So I'm just going to jump ahead and expect that to occur. I'm not going to waste any time evaluating. Ambiguity bias, the brain does not like. As you look at this slide in front of you, you'll see on the left box, ABC, and on the right box, 12, 13, and 14. That's the way the brain is interpreted. But why, if you would, couldn't it be A, 13C, or 12B, 14? Your brain just decided to take a shortcut because you had a sequential number, 12, 13, 14, and sequential letters. Now take a minute too and think about the box in the middle. And approach the bank. What's running through your head right now? Probably you're envisioning a woman walking into a branch office of a local bank to make a transaction. Again, your brain assigned that without any effort at all. But why couldn't it be a young lady canoeing down a river that is now veered over to the shore, to the embankment, to climb out of her canoe? The brain doesn't like ambiguity. It will take its shortcut as quick as it can. Again, working on the fast, slow thinking. I'm about to ask you a mathematical question. It's a plus or minus. I like to refer to it as a Jethro Bodine math, a gazintas kind of thing for anybody who grew up watching the Beverly Hillbillies. I'll pause for a chuckle there. No? Okay.
Yeah, I used to watch that.
Paul, we're old.
We're old.
We're old. So I'm going to ask you, and the truth of the matter is, I know, without a doubt, you're going to get the answer to this question. I have no concerns about that at all. What I'm really going to try to measure is how quickly you can arrive at the answer. So if you will, I'm going to ask Paul, pay attention to the students. I'm going to ask the question, and you tell me how quickly, you just cut me off and tell me when the first person raises their hand with an answer. You ready? Here we go. I have a piece of candy and a piece of gum that cost $1.10. The candy costs $1 more than the gum. How much does the gum cost?
First hands up. 10 cents. Gentleman said 10 cents.
10 cents. That's great. Now, I want the rest of the group to notice he did that almost faster than you can blink your eyes. He took numbers. He $1.10, $1, gum, candy. I got this. It's going through the brain. Bam. He rendered an outcome of 10 cents. Now, I can't see the young man that said that, but I'm going to ask him, do you want to stick with your answer?
He said, sure.
My guess is when I said that, if you think hard about it, you could actually feel that equation move inside of your brain to a different quadrant. In other words, you did the math, you came up with an answer, you felt confident, but the old fart on the phone said, hey, I'm going to challenge that. So you pushed it out to another part of your brain, and now you're thinking, was it right? I think it's right. Well, I don't want to embarrass you, but the correct answer is 5 cents. And so that you're not embarrassed, I want you to also understand that 90+% of the audiences that I asked this question of also answer 10 cents. This is a sign of a heuristic. Your brain saw numbers, pluses and minuses. It wanted the quick, easy answer. It didn't want to work. Now, let's focus on it. The algebraic equation, just so you know, I'm not making this up. I know you guys are finance guys. You want to see this. I, as I said, prefer the Jethro Bodine that goes into. Remember, the candy and the gum together are $1.10. I said the candy costs $1 more than the gum. So the candy alone can be $1.05. The gum alone is $5. That gives me $1 spread. This is an example of thinking fast, thinking slow. All human beings do this. Every piece of sensory data that your body takes in, sight, sound, smell, taste, whatever, right? Every piece of sensory data comes in through the brain atop the basal cortex in a area called the amygdala. There are two lima bean shaped parts of the brain, very small, that sit above atop the basal cortex. It is more often referred to as the fight or flight section of the brain. In 1/64th of a second, every single piece of data you take in passes through that part of your brain, and you make a decision. And then that information is pushed out to other parts of your brain to be rationalized after the fact. That's why it was so easy to say 10 cents to this question. Now that you think about it, you'll never make the mistake again. But that's how the brain works, and understanding that. This next one, very
By
simple.
the
You've
way,
all seen it.
Joe, let
Yes,
me just
Paul.
tell the gentleman, we did this a couple of weeks ago in Houston, and almost everyone there got it wrong too. So feel bad.
Everybody does it. By the way, I did it. I got it wrong, so don't be impressed.
I got it wrong too.
By the way, the finest nerve, interpretive nerve in the human body is the optic nerve. And so I put this together just as you look at this. Are the lines horizontal or do they slope a little bit? Well, of course, you've probably seen or heard about this. They don't slope at all. But if I can fool the optic nerve, I can fool any part of your brain. And that's what we need to understand. So let me give you a real life example. This is always kind of fun. Let's see, you guys are all seniors. So you were little tiny tots when this occurred. But if you roll the clock back almost 16 years now, there was a plane that boarded at LaGuardia Airport, New York City. It was destined for where I live, Charlotte, North Carolina. I want you to think about that. There were 150 passengers boarding this flight on that day. What do you think those passengers had running through their mind as they were getting on the plane relative to the flight? I think it would be safe to assume most, if not all of them, were thinking about a lot of different things, one of which might have been, God, I can't wait to get on this plane and get to Charlotte or somewhere near Charlotte where I intend to go. I just want to get home. Would you agree? Well, let's fast forward. 5 minutes later, those 150 passengers found themselves floating on the Hudson River, standing on the wing, or floating in rafts. Now let's fast forward 16 years and assume those people still fly. Do you think when they board a plane today, they still think about, boy, I hope this gets where I'm going soon? Or do you think they have secondary thoughts like, oh my gosh, I hope I don't crash again? Well, what's interesting about this experience is that's me, the big chubby guy out on the tip of the wing. And I can tell you without equivocation, I cannot board a plane today, and I board on average 3 a week. I cannot board a plane today where my palms don't get just a little sweaty, my heart doesn't palpitate just a little bit, and my breathing doesn't get just a little heavier and faster. Now, I need to ask you a question. Is that rational thought? No. It may be logical, it's not rational. Air transportation today is the single safest mode of transportation on the planet by a wide margin. And yet, I get nervous getting on a plane because of something I experienced 16 years ago. Funny part is, when I land, I'll get in a car with just about anybody. Half the time, they don't even speak my native language. And I'm not afraid of that. There's a greater probability I'll die in a fiery car crash on my way to or from the airport than I will in a plane crash. And yet I'm afraid to get on a plane and not afraid to get in a car with a stranger. That's not rational thought. So what I want you to understand is our thought processes, our decision-making process is based on experience, correlation, and the impact it's had on unexpected income. I expected to land in Charlotte that day. I ultimately did, but not the way I thought I was going to. And forever, that will be in the back of my mind and will influence all the decisions I make when it comes to travel. So it's expectation versus experience. You can think about your own experiences. And if you really want to have fun, think about experiences you've had in investing and how it impacts decisions you make going forward. But expectations and experience, they're one and the same. It is part of our evolution. We would never pursue uncertain rewards without the motivations of hope and greed. But we would never survive if risk did not frighten us. It's just normal. It's human. Unexpected gains and losses are extremely intense, as that event was on January 15th, 2009. But here's what's fascinating. Expected gains give us far less pleasure when we receive them than we were having thoughts about them. And expected losses give us far less pain when we suffer them than when we were thinking about them in advance. One of the ones I like to use as an example is in my 37 years, I've held several management positions, and from time to time, I've had to let somebody know that they weren't performing up to standards and they would no longer be employed. The funny thing about this thing is I would anguish over having to deliver that news. That's a hard thing to have to tell any human being. And invariably, after the meeting was done and they would leave my office, usually not happy, my HR representative would come in and say, how'd it go? And keep in mind, before the meeting, I was just anxious, palpitating, didn't want to do it. And at the end, I would usually say something dopey like, well, it wasn't as bad as I thought it would be. Or how about this one? The most feared thing by human beings worldwide is public speaking. When interviewed, most people would tell you they would rather die than get up in front of an audience and speak. Interestingly enough, I'm one of those people. And invariably, after I would leave the stage, somebody will tell me, ask me, how'd it go? And I would say, not that bad. So while I'm waiting to go up, I'm terrified. When I'm done, I'm not. You might not recognize this about yourself, and you definitely won't recognize it about your clients or your friends. Expecting dough versus expecting dope. Here's what's interesting. Baseline study. This is a functional MRI of the human brain at rest. This is the human brain of a drug addict anticipating a hit of cocaine. Now, I want you to understand in the study, they never got the cocaine, but they were promised it. This dark area that is lit up in their brain is basically saying, give it to me, I want it, I want it, I want it. Here's what's fascinating. Here's the average person expecting a financial gain. Notice the resemblance and how the brain activates in expectation of excitement. A financial gain versus a drug addict and drugs. This is how our human brain works. This is why we make the decisions we make. We all have these investor biases. By the way, there are at least 6 other slides with this number of biases and on them. But these are some of the most common. I'm going to fast forward. I'm going to skip through this. Let me do this one because I know we're getting close to dinner. What I want you to do is watch this video and tell me how many successful basketball passes occur between these teammates. Oh, no. This is one of my favorites, and I blew it. Well, that's good for you guys. You don't have to watch it. All right. It's a fun one. I'll find a way to send it to Paul, and you can see it in one of your next classes.
Cool, thanks.
I'm not going to go through these. These are some of the performances, but I know we're bumping up against our time limit. Risk trades. I represent multifamily, so what these are reflecting to you are the risk-reward characteristics of multifamily versus other commercial real estate investments. Multifamily has long time been considered the golden child, if you will. And that's based on these statistics. I won't bore you with any of that stuff. You guys are all getting out of college, so you know it's almost impossible to buy a house today, even if you can find one. Our background, we've been doing this for better than 30 years. We started out as a research company. We've evolved as investors. We used to sell our research to subscribers. We've done a lot of other things. This is our process. You don't necessarily want to see this. This is our current portfolio. These are our leaders of the company. We've been doing it a long time. We're very, very big. We've transacted in the last 10 years in over $2 billion worth of real estate transactions. As I told you, we own $570 million worth of apartment buildings across the country today, 6 states, 12 properties, et cetera, et cetera. And we have new ones all the time. That's our performance slide. So in summary, I started out, I said we wanted to talk a little about asset allocation, portfolio construction, modern portfolio theory. We segued, hopefully, and you enjoyed it, into behavioral finance, and with a real world example, maybe a couple. Skim through that one. I basically promised you, or tried, I said my objective was to give you some educomedy. So my real question is, did I succeed? If I did,
yes.
if I did, I want to thank you for your attention. Paul, thank you so much for having me.
George,
I'm available if anybody needs any of this or wants to talk further, but I'm sensitive to mealtime. And as an old man on the East Coast, I'm sensitive to turn on Johnny Carson. Okay, he's not on anymore, but Paul, you'll know what I'm talking
I
about.
know what you're talking about. John, we still have a few more minutes, if it's okay with you. I know one question that's always in my mind, because they ask me this all the time. You guys want to start with a question? And I'm curious to see if you ask the same one I'm thinking. Do you still have a few more minutes, Joe?
I have as much time as your team wants me to be here.
All right, guys, what questions do you have? I'll kind of start it out for them. So I know I've asked, probably half the classes asked me at some point in time during this past term, because they all graduated as seniors, right? And so the big thing on their mind is what? Money. Well, and money, and what else? Jobs, yes, okay. So can you give them some thoughts about, how to get into our business as a career, and, how to kind of break into it?
Beg, borrow, and steal. It is the greatest. It is the greatest business, in my opinion. It is the greatest business on the planet. I love it. I love it. I don't intend to retire anytime soon. I've been doing it 37 years, as I told you earlier. Depends what you really want to do is sit with somebody like Paul or related industry people, because there's different levels in our industry that you can participate in. As I told you, I've been on the manufacturing and distribution side my entire career. I have no desire to work directly with individual investors. That's not my strong suit. I don't have the patience for that. So I am in what they refer to as a kind of a gray area. I'm what they call a wholesaler. So I am the intermediary that goes between the investment sponsor, be it a mutual fund or a REIT or whatever, and the investment professional. And my job is to train, teach, educate the investment professional on what my company does, where it fits in a client portfolio, if at all, and how to talk to the client about that. Financial professional is the one who talks to clients and actually works with them day to day to assess risk tolerances, income needs, long-term wealth accretion goals. You could also go the other path and be a professional portfolio manager or fund manager for one of the fund companies. Again, it all depends on what your passion and what your personality, but talk to as many people as you can in our business, get a sense for what each one of them does, figure out if one of them is a passion of yours, and then just run hard. I talk to people every day. Matter of fact, I just met with a fellow from UNC Charlotte last week. He saw me at a seminar and asked me out to lunch and picked my brain for 2.5 hours. And I think he's going to go into the investment professional, the financial planner side of the business. But I don't know what else to say to you, Paul, but uh, most of the guys in our business are here and want to help. We like smart, good people that will, tell investors the way it is. There's not enough of us, and we need more.
So, I know, like I say, a lot of questions I get from this group and others, they're graduating. So what would be kind of a first step for them to do to kind of break into the business, or first steps?
Okay, so if you want to load the deck, if you will, since I came into the business, they've changed the process a little bit. You used to have to get hired into the business and then sponsored for your licensing. Today, it's not the same. Today, you can actually go get your SIE, which is a Securities Industry Exam. You can study on your own, take the test, and that's the first half. It's a prerequisite to getting your securities license. I would suggest if you have a true interest in this, you go down that path, get your SIE, study, pass. So that's in your hip pocket. And then when you come in, I would suggest you, at a minimum, get your Series 7, which is general securities. And then I could give you other guidance, but those are kind of the table stakes. If you have your SIE, there's a greater likelihood somebody will talk to you in earnest about getting a job. Because if you've taken that step, it shows that you're truly interested and committed to going down this path. But that's the first step I would take.
Yeah, I think that's good advice. What questions do you guys have?
I have a question. I know he mentioned a gentleman that he
Joe, can you hear him?
probably not.
Can you hear the question he's asking?
Go ahead. I think I can. I'll ask to clarify if I can.
Yeah.
Okay. I know earlier in your presentation you said you knew a gentleman who was very intellectual in your finance career, but also a savvy businessman. I was wondering what were those traits that you saw in him that stood out for you as a savvy businessman?
Traits that stood out in who and by the way, I never said I was a savvy businessman. Stop putting that on.
You mentioned, I can't remember exactly his name.
Don't put that on me, Ricky Bobby. Don't put that on me. So you're talking about
I think he worked at Vanguard. That's what you mentioned. He worked at Vanguard.
Oh, yeah. Well, he built an empire. Vanguard is what, the third or fourth largest asset manager on the planet today.
Yeah.
And John Bogle founded it, started it. He was great at marketing. He attacked the financial services industry with public commercials, saying we were worthless. Built a heck of an empire. So that's why I think he was a smart man. He knew what he was doing, and he did it very, very well. He has since passed. He's not with us anymore, but his legacy lives on.
Second question I have is, do you believe that fintech is another option as well?
Fintech, yeah. That, by the way, that's that's a fantastic area to be in. I am not well versed in it at all, so would not be the guy to talk to in any way, shape, or form. I have a very smart team around me. They protect me, they insulate me. But yeah, that's the direction where you don't necessarily have to interact with anybody in the public. But if you like technology and security, and we are a highly regulated industry, and our fintech is always evolving.
Sir, go ahead.
How would you recommend stepping into the real estate world from the investing side?
How much money do you have?
Definitely not enough.
Well, unbiased, I would say you should invest in my REIT first. No, I'm only kidding. That's no. It depends on what you want to accomplish, to be direct with you. There's a lot of different ways. You could own direct. You could buy rental properties where you manage and take care of them yourself, so you get passive income, tax write-offs, and all that kind of stuff. It's a little capital intensive and as well as time intensive. If you want to be less active, and you want to have direct ownership, you could look at some of these programs that people like I offer, that our company offers, or there's other platforms out there that offer you easier access as well. Or if you just want to dabble, and I'm not a huge fan of this because I have to be careful when I say it, but as you're building a portfolio, if you don't, the challenge with ownership of real estate is whether it's direct or through a REIT like mine, it takes a lot, it takes money and or special accreditation to be able to get in. So in the early years, when you don't have a lot of money, but you want to balance your portfolio, I would suggest you look at traded REITs. Now, I want you to understand before I leave that topic, that traded REITs will behave more like traded stocks than they will real estate. But because the underlying investment is technically real estate, they have a marginally lower correlation than the stock market as a whole. They don't add all the same benefits that direct ownership of real estate has, but it is a way to get started. So, if you want to talk offline, we could explore a lot of other avenues that might work for you. But that's kind of a protect me type of answer.
Yeah.
Thank you, appreciate it.
Other questions? We have a couple more minutes left. Anybody? All right.
Paul, before you go, I can't believe I wasn't asked a question what Sully was like. I can't believe I wasn't asked the question. Am I this handsome in the movie, Sully, as I am on this screen? And several other questions. But okay. These are true finance guys.
Yeah, they are.
Were you in the movie, Joe? Were you in the movie?
Yes, I am. Yes, I was.
Wow, excellent.
I actually had dinner with Clint Eastwood at the Ritz-Carlton Hotel in Charlotte after the last day of filming. I got to sit right next to him. And I was also on the Ellen DeGeneres show. So there you go.
And I'm curious. So after you guys got off the wing, in the middle of the river, did you get on a plane and fly home right away?
Well, again, as I started this conversation, I'm not the brightest bulb in the pack. So, true story, while standing on the wing, thigh deep in 34-degree water temperature, 27-degree air temperature, broken nose, bleeding like a stuck pig, I called US Air and I booked my flight home that night. I landed in Charlotte at 12:05 a.m. Friday morning.
I love it.
Not a smart man. Not a smart man.
But you got home.
I got home. I was in my own bed.
Joe, we can't thank you enough. That was absolutely excellent. And let's give him a hand, guys.
I wish you all good luck in next week's finals. If Paul gives you any headache, if Paul gives you any grief at all, let me know. I know where he lives and I will hunt him down.
Joel, watch out for you. Joe, thank you so much again.
Thank you.
All right. Good night, guys.
Take care.